and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman alongside Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Any growth data right now is probably going to carry a little more weight than it otherwise would have. I think, the PCE data this morning, largely known, people had a pretty good forecast of that. So, everything is about the growth side of the economy and everything is about the consumer. So I think any data that suggests consumer spending is holding in and you're not seeing the weakness that people are worried that the Fed is worried about, I think that's all going to be red positive for equity markets.
We look at all of these data points as just another input, but no single data point tends to lead us toward a conclusion. Again, it's good to see a little bit more positive trend, not too surprising after the Fed move we just saw.
What I would just say is that we've come on a string of pretty good inflation readings over the last several months. And that was coming after an acceleration in inflation in the first quarter. So I think Fed officials are feeling pretty good about where inflation's sitting. I think the more important thing is that labor markets have loosened quite a bit, and on some measures are now looser than where they were in 2019.
We got 1 hour to go until the market close, so let's take a look at the major averages. And you heard there the guest talking about PCE. That was one of the big drivers, the Fed's preferred measure of inflation, coming when all is said and done pretty benign, right? Whether you look at the core number or whether you look at the headline number. And so you've got the Dow higher by 216 points at 0.5%, but the S&P and the Nasdaq are lower. Now the S&P, of course, did close yesterday at its 42nd record of the year. So kind of sideways, a little change from there. The Nasdaq, though, is down a little bit more, about 0.4%.
The PCE data was interesting, Julie, just the response to that, because there was, obviously, not surprising, a lot of chatter immediately. What does this mean to the Fed, their path and trajectory of rate cuts? While economists were kind of saying, maybe you take a deep breath, because for one, you got a lot of data between now and that next meeting. And two, frankly, they were saying at this point, it is the labor market that is more pivotal, more important to determining the size of that next cut, more maybe than these inflation numbers at this point.
Indeed. I did see some commentary around the idea that it was sort of a toss of a coin, whether it be 25 or 50 basis points cut by the Fed at the next meeting, that this didn't give a lot more clarity on that front. If you look at the 10-year yield, for example, you saw it falling a little bit today. So there seems to be some debate on this point for sure about what's going to happen next, and that's sort of being reflected across what we're seeing. In terms of the sector action that we're watching today, tech flipping, right? Yesterday we were seeing tech up, today it's down by about 1%. And energy kind of switching places here. Energy, the big outperformer today. And if we look at the underlying commodities, we can see why here. Looking at the intraday chart for oil, you've been watching this situation really carefully.
Well, I mean, you have red hot geopolitical headlines, right? You have Israel carrying out a big strike in Lebanon and reports noting they were targeting Hezbollah's leader. I saw Axios actually reporting, Julie, that Israel's Prime Minister Benjamin Netanyahu has cut short his trip now here in New York, headed back to Israel. That is, as Axios rightfully points out, that is unusual for him to fly on Shabbat. On the other hand, you have this bearish effect you have to keep in mind too. These reports that Saudi Arabia committed to higher production. So you do have a lot of very powerful cross currents. And we have got a smart oil analyst later help us walk through it.
We do indeed. And I also want to take note of what we have seen over the past week or so in oil, because we have seen a decline in oil prices on those other cross currents that you mentioned. The Saudi Arabia headlines that there is a plan to roll off the production cuts later this year. There's also some headlines out of Libya where there have been two factions sort of in conflict that have now come together to agree on a central bank governor. That then has been raising some hopes that there would be oil production increase, their hopes, I guess, on the part of people.
And then throwing China on top of that.
Throw China
all the stimulus
on top
measures,
of it.
whether that works, for sure.
Yeah, so a lot of questions on the geopolitical front.
Let's ask a man for some answers.
Let's
go there. For more on the latest market moves, want to welcome in now David Bahnsen, the Bahnsen Group CIO. David, it is great to have you on the show. Want to start, David, with all the economic data we got this morning. Inflation, was just talking to Julie about that. Personal income, consumer spending. There were folks, I'm sure, David, they looked at that data and they said, listen, that is more data, that is more evidence that we have an economy that is cooling but not crashing. And maybe as rare as it is, Jay Powell actually did stick that soft landing. How do you see it, David?
Well, I agree that the data is reasonably benign. It doesn't reflect a red hot economy. It does reflect some degree of slowing down the pace of advancement, but nevertheless still hanging in there. The only thing I'd push back on is that Jay Powell stuck the landing. I think that this is totally unrelated to the Fed activity for the very reason that the Fed shouldn't have to try to stick that landing. It's impossible for 12 people around a conference room table to guess right what every nuance and variable from employment to prices, wages, all the other factors you brought up are going to do. So far, things are pulling together here, and we're going to see what 2025 brings.
We will see what it brings. In the meantime, we're not sure even what the next few months of this year are going to bring, right? We don't know, what size the next couple of cuts from the Fed are going to be. We don't know who's going to win the election. We don't know the outcome of some of the geopolitical elements we were talking about. And you think all of this is going to result in some increased volatility. How should investors sort of approach that?
Well, I think that both things we're talking about, both the preconditions for Q4 that you just described and what I'm about to say I think investors should do are permanent. The idea that there's geopolitical instability is a permanent part of human nature, that there's some form of domestic political uncertainty is a permanent part. It's true, it's heightened with the unknown of the election. But even the issue of monetary policy, for the first time, I actually think there's quite a bit of certainty. Is it going to be 50 in November and 25 in December or vice versa? I don't think it matters at all. But we know that they're going to be taking another 50 to 75 basis points out of the Fed funds and pursuing more of the same next year. Our solution is always in dividend growth equities because we simply believe cash flow is one element that allows you to not have to try to guess exactly what's happening in the macroeconomic environment. For income investors, they get consistent growing cash flow. For accumulators, they actually benefit from volatility. So we've just philosophically centered our money management around dividend growth equity.
Let me ask you, David, about another big theme we talked a lot about on the show this week, Chinese authorities taking these steps, David, to boost their struggling economy. I'm curious whether you think they're taking the right steps, whether, David, you think they'll be successful, and two, do you want to buy Chinese equities here?
Well, we do not, but they most certainly are likely to continue going higher around the monetary stimulus. They had been doing some form of fiscal stimulus most of the year, but I think to avoid a lot of the mistakes that Japan has made, and very candidly, a lot of the mistakes the United States has made, they've been more gun shy on some of the monetary. Now, look, a 50 basis point reduction in the reserve rate and some of the other elements that they've done is still a long way from full-blown quantitative easing, for example. But this was unexpected, and that's why markets have responded the way they have. Is the People's Bank of China largely indicated they weren't going this route, and Xi seems much more open to using monetary stimulus. That gives some degree of asset price boost behind it. You asked what I would do. Well, I would prefer it be a free country that allows a full-blown free enterprise system. And so I'm a big fan of the rule of law and other forms of capitalism. That's what I would do. But no, I mean, in their system, this is probably the best thing they can do for short-term asset prices.
And on balance, do you think, we don't know the outcome of this stimulus yet, but on balance, do you think that is positive, not just for asset prices there, but potentially for economic demand globally, for example, U.S. companies that sell their goods into China?
Yeah, I do think that there is a marginal benefit there, as a matter of fact. And it's something I've studied for a long time, that there is a global interconnectedness here that everyone's well aware of. In this particular case, though, we're so used to thinking of China as exporting to us. And so when U.S. demand weakens, therefore it hurts China's capacity as an exporter. This is a little bit different, though, and I think that China's overall economic health now just leads to a knock-on effect in terms of their other trading partners, not just the United States, but other counterparties in Asia and Europe as well.
David, you follow politics very closely. If you were to look at the polls, Trump-Harris, they would suggest it's a toss-up. What do you think the market wants here, David? Is it a Republican sweep, Democrat sweep, divided government?
Yeah, it's funny. I just wrote about this today in my dividendcafe.com. We did a special election issue, and I make the argument that divided government is historically something markets have liked quite a bit. The possibility of a Democrat president with a Republican Senate is not something I think markets would fully reject. Energy in financials, the overall regulatory environment, and certainly tax policy, there are reasons that the market would prefer probably a Republican in the White House. But if they're going to have a Democrat in the White House, particularly one talking about higher taxes on capital gain and all these other things, I don't think they're ever going to pass with a Republican Senate. So divided government, gridlock has historically been pretty good. And that's been the bulk of my adult life. And I'm 50 years old. So divided government has worked well for markets.
It certainly has historically. David, thank you so much. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, the FDA has approved a new Bristol-Myers Squibb schizophrenia drug, and shares are jumping today. We'll check in on some of the top trending tickers on the other side. Plus, time is running out to avoid the first major strike at East and Gulf Coast ports in decades. We'll speak to an expert on the matter about what comes next. That's later in the hour. Stick around, much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now, time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Shares of Bristol Myers Squibb, they're jumping today after the FDA approved the pharmaceutical giant schizophrenia drug. The FDA saying in a statement, quote, this drug takes the first new approach to schizophrenia treatment in decades. The share's up about 2% right now. And indeed, many of the existing treatments on the market for schizophrenia have various side effects, including weight gain, and folks who are on it complain of apathy, et cetera. And so this is a little bit of a different approach, which also avoids a so-called black box warning, which includes some of the more severe side effect warnings. And so there seems to be a lot of hope around this particular drug.
Yeah, and this was, I guess, Julie, the bet that Bristol made when it agreed to buy Karuna last year, that Bristol would be able to create some new revenue streams here. And with some of its key drugs, I guess, losing patent exclusivity. I did see some analysts cited as estimating the pill could generate about $5 billion a year in peak sales for schizophrenia. The stock, though, I mean, under real pressure. So a bit of a pop today, but you pull back the chart, it's gone nowhere this year.
Yeah, I mean, and just to give another bit of perspective here on the potential for this particular drug, it's estimated that 2.8 million American adults have schizophrenia and 24 million people worldwide. What's key next now is what kind of coverage it is going to get from Medicare and Medicaid specifically, because a lot of these folks are on Medicaid because of, either not being able to work or what have you related to this illness.
All right, keep an eye on it. Next up, Cassava Sciences shares falling after reaching a settlement with U.S. regulators, U.S. securities regulators. This comes after the pharmaceutical company was charged for misleading claims about an Alzheimer's clinical trial. So regulators saying the company, along with former execs, is going to pay more than $40 million, Julie, to settle charges related to misleading statements made about the clinical trial of its Alzheimer's treatment. This is per Dow Jones, which notes 3 parties were charged with violating anti-fraud provisions for the drug, including the founder and former CEO.
Yes, that CEO who stepped down in July. So this has been sort of going on for a little while now. The talk about these allegations and about this investigation. That former CEO is Remy Barbier. He's going to pay $175,000, and then their former head neuroscientist also will be paying a fine here. The new CEO of the company is Rick Barry, and he has said that they are going to pursue phase 3 trials of this drug. So they are not giving up on the drug, but first they have to move past this history here, which apparently included these results that were not entirely on the up and up.
And a rough reaction in the stock today.
And then sort of in a similar situation here, we're watching Acadia Healthcare. Those shares are sliding today. This company operates mental health and addiction treatment facilities. It was ordered to pay almost $20 million in order to settle allegations regarding billing government programs for unnecessary services. It looks like there is now also a new request for information from the Southern District of New York, the attorney's office there, and a grand jury subpoena. There's been some New York Times investigating into the company and whether people who were in its facilities needed to be there as long as they were there. And so now some of these allegations are kind of continuing.
So the stock is getting wrecked here today. It's got 16%. If you're a bull on a stock, what do you say in a day like this, Julie? What do you say? So I checked in with one such bull, RBC's Ben Hendricks. I wanted to find out what he was telling clients because Ben is a fan. He was saying, listen, this is what he told his clients. For sure, incremental negative. He was arguing the sell-off is well overdone. He told his clients it is a new overhang. He acknowledges that, but he says investigations of this type, nothing new for healthcare providers. And he says the response he heard from management here reaffirms, he says, the company's confidence in its care protocols. So big headline, big reaction. We'll see how it plays out.
We will see, indeed. There's something else that we're waiting to see how it's going to play out because time is running out to avoid the first major strike at shipping terminals along the East and Gulf coasts in nearly half a century. White House officials are calling for dock workers and port operators to settle their differences. But at this point, it does seem unlikely. At least that's according to our next guest. Just into Yahoo Finance as well, a group of White House officials, including Transportation Secretary Pete Buttigieg and Acting Labor Secretary Julie Su, are meeting with United States Maritime Alliance representatives to push for a deal. Joining us now to break down what's at stake, senior fellow at the Burns Center for Social Change and the former top labor policy advisor to President Biden. That is Seth Harris. Seth, thank you so much. So obviously, this is a very important economic issue. It's also a very important political issue. So it is interesting here that the Biden administration does seem to be sending proxies. It seemed initially as though President Biden wanted to be a little hands-off here. What do you take, what is this signal that we are seeing some cabinet members start to get involved?
Well, this has been the method that the Biden administration, the Biden-Harris administration, has used to deal with major strikes, very large-scale, economically important strikes. Is they urge the parties to come to the table and to bargain, and then they offer cabinet secretaries as sort of cheerleaders, mediators, cajolers, beggars. They're trying to just put pressure on the parties to keep the public interest in mind and to try to get to a resolution. So this is fairly typical pattern for the White House. I don't think it's an indication of anything extraordinary. Other than that, this is a big, important labor dispute, which it self-evidently is.
You know, Seth, it sounds like a potentially tough dance or tough tightrope to walk here, because if you're Biden, Harris, you don't want a port strike. You don't want to suffer any kind of economic damage, of course, weeks before an election. At the same time, you don't want to alienate union members. How do you kind of walk that line?
Well, the president has been pretty clear about his perspective on this. He has the authority under a law called the Taft-Hartley Act, the Labor Management Relations Act, to go to court and seek an injunction that would effectively end the strike. It would create an 80-day cooling off period. And President Biden has said, I'm definitely not doing that. I'm not going to seek an injunction. And so he's made very clear that he wants collective bargaining to work. He wants workers to have their say in their working conditions. He wants them to be able to use whatever economic power they have to get what they feel is owed to them. That has been his position very consistently throughout the course of the administration. The only exception to that was the national freight rail labor dispute that occurred a couple of years ago. It's a different law. There are different requirements under that law. And also, remember, we were in a much more precarious situation back then. Supply chains were broken. They were struggling. Inflation was beginning to climb because of those broken supply chains. We don't have that anymore. Supply chains have healed. And so I think he's less worried about the macroeconomic impact of this kind of a strike.
What is your estimation of that macroeconomic impact, Seth?
Well, I haven't run the numbers. That's somebody else's job. I'm a lawyer, not an economist. But my sense is that consumers won't begin to feel any meaningful effects from the strike in the first week or two, if it lasts for that long. My expectation is that retailers and manufacturers and other importers have inventories built up that will allow them to withstand some period of strike. I think that if there are pressures on products, it's most likely to be perishable goods that are coming into the United States. Although with the kind of refrigeration that we have right now, those goods also can last for a good long time. So I don't think it's going to have an instant effect. If we see prices rise extremely rapidly, I think what President Biden and Vice President Harris will do is urge the Justice Department and the Federal Trade Commission to investigate those who are raising prices for price gouging. That has been a central theme of Vice President Harris's campaign. I don't think they want to see it here. But I think if the strike does last for multiple weeks, then we're going to begin to see some economic pressures in some industries that depend very heavily on imported products and imported inputs into finished products in the United States.
Any sense, Seth, of what an ultimate deal could look like that would make the dock workers and the port operators happy, that everyone could walk away satisfied?
I think that might be too high a bar, Josh. I think that making everybody happy is going to be impossible here. Somebody is going to be unhappy. The dock workers are pushing very aggressively for substantial wage increases. They feel they are owed a much bigger share of the massive profits that the shipping companies and ports and terminals, which are co-owned in essence, have been making over the last several years. They made a killing during the pandemic when Americans' buying habits moved from services to goods. So these workers want their fair share of those profits. So they're making very aggressive wage demands. But there are other issues, benefits. Also, automation is a very important issue for this union. There's a real risk to jobs from automation in the longshore industry. The companies have been quite resistant to raising their wage demands and to giving in on automation issues, although the contract language now is quite worker protective. So I think they feel there's not a lot more that they should do. At the end of the day, we're going to end up with a deal that is somewhere in between the current offer from the companies and the longshore workers' demands, the ILA's demands. My guess is it'll lean towards the workers. They won't get everything they want, but I think they'll get a larger share of their demands.
Seth, great to have you on the show, helping us walk through a complicated topic. Thank you for joining us.
Thank you.
How are Apple investors feeling about the recent slump in iPhone demand? We're going to speak to an analyst on the other side about the latest. Stick around. More market domination still to come.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Apple's iPhone 16 has been available for a week now, but the outlook for sales coming in mixed. Our next guest says the payoff from the delayed launch of Apple Intelligence will play out over a longer time horizon. And joining us now is Antoine Scheibon, New Street Research Technology Infrastructure Analyst. Antoine, it is great to see you. So here's what you're telling your clients, Antoine, that you expect 215 million iPhone shipments in 2025, and you say that would be 10% below consensus. How come, Antoine? What do you see there?
Yes, thanks a lot, Julia and Josh, for having me. So yes, we're concerned about the upcoming cycle for a number of reasons. First, there are early data points suggesting that iPhone 16 reception is poor. Users are often disappointed. They see limited innovation. And as you mentioned, the fact that Apple Intelligence won't be rolled out from the beginning doesn't really help. Second, there is evidence that refresh cycles are lengthening. You see that in the upgrade rates reported by US telecom operators. Reality is that iPhone users hold onto their devices for longer. And third, in China, iPhone gained share over 2020, 2022 as the only alternative to Huawei in the high end. And this is now creating a headwind to shipments as iPhone share gains are reversing with the domestic OEMs stepping up competition. Lastly, there is evidence that broader consumer demand is weak. You see that in various markets. You see that in smartphones, you see that in PCs, you see that in autos. And so when you put all that together, we think it's legitimate to be concerned about the upcoming cycle. And so we expect indeed that, as you mentioned, 215 million iPhone shipments in fiscal 25. That's 10% below consensus with elongating cycles and slowing net adds.
Antoine, when you look at the introduction of Apple Intelligence, when it does come to the phones and to the last model as well, do you expect then to see sort of a delayed pickup in demand?
So I think if you look at it over the longer run, I think that the generative AI iPhone revolution indeed won't be hardware driven. It will happen over multiple cycles. It won't create a near-term product cycle, but it will still revolutionize the user experience over time. And I do believe that Apple is very well positioned to capture some value as they control a large ecosystem of high-end devices. And so, yes, I agree that beyond next year, over coming years, I think Apple can do well with generative AI, with Apple Intelligence getting rolled out, but it's not going to drive a near-term product cycle. That's what we're concerned about.
So concerned about the near term, Antoine, do you get more bullish as you look farther out, for example, 2026?
So I think beyond next year, Apple can grow revenues probably mid-single digits. I mean, if you take a step back on all that, I think growth has peaked on most fronts. Like iPhone peaked in December 21, Mac in September 22, iPad in December 20, and the installed base in general, not just for iPhone, growth is now slowing and refresh cycles are elongating. Now you have services that are at an all-time high, and that's driven by the App Store, by licensing, and that collection of businesses will likely continue to grow in double digits in aggregate. But we see limited room for an acceleration in the near term. So bottom line is Apple can probably grow revenues mid to high single digits and earnings between low to mid-teens. And so, yes, over the long run, I think Apple is definitely a good name to own. And if there is indeed a pullback related to weakness in the current cycle, that would probably create a good entry point.
Antoine, I thought it was also interesting that you pointed out in your note that Apple stock doesn't move as much, specifically on iPhone sales, which as it did in the past, right? Even though this is still the biggest chunk of its revenue, right? So what are sort of the inputs then to the stock price? Is it sort of the services revenue, for example, that it also is more reactive to now?
I think yes. I think it's whether Apple can continue to drive earnings power over the long run, and so you have multiple components to that, but not a near-term product cycle, I would say. And so, of course, you have like the whale opportunities, like for example, Vision Pro. It's still very early on that front, and the user experience looks very promising with positive reviews. The reality is we're still waiting for the killer app that will drive adoption. But I think over the long run, it's adding up all these whale opportunities, generative AI, VR, that actually is becoming more important controversies for investors than whether Apple has a good or a bad cycle in the near term. And we're convinced that Apple actually can capture some value from generative AI and from VR, but it's not something that's going to happen overnight. But yes, we are positive on Apple over the long run.
Are there certain, Antoine, of the new AI features you saw from Apple, are there certain ones that you would expect are going to be more popular with consumers than others, or is it too soon to say?
So when you look at, we analyzed the consumer reviews of the beta. There's a beta already out for Apple Intelligence. I think at this stage, reviews are not very, very positive. When you look at, for example, like the capabilities, the fact that when you compare it to ChatGPT, that you can actually have running on any phone. You don't need, to have Apple Intelligence to run ChatGPT. You don't need the latest iPhone to run ChatGPT. You can actually, for example, summarize emails and perform a lot of edits on text that actually are running better on ChatGPT than on Apple Intelligence. Now you have some features that are doing better. You have, for example, the capabilities of the new photos. You can search photos much more intelligently. And reality is that I think where Apple can make a big difference is by tightly integrating generative AI with the operating system. And that's what they're doing. But in the near term, I think it's going to take time. It's not going to happen over a single cycle. I think it's going to take time to get right. And yes, that's why we think it's not something that will impact, like the next product cycle, but probably the next few ones.
All right. Well, we'll be eagerly awaiting the shipments in the meantime. Antoine, thank you very much. Appreciate it.
Thanks for having me.
Now let's get to some calls of the day, sponsored by Tasty Trade. JP Morgan's out with a new note on Novo Nordisk. The analyst there saying sales of the weight loss drug Wegovy may be weaker than expected. And this seems to be sort of part of a bigger trend here of a little bit of the enthusiasm coming off the boil for Novo and for Eli Lilly to some extent as well. Specifically here, the JP Morgan analyst, whose name is Richard Vosser, says that the Wegovy sales, the numbers for the third quarter, may be a little short of estimates.
Yeah, so in the red here, it looks like today, Julie, we actually Novo Nordisk, we hit a 7-month low in today's trade. I did see analysts at JP Morgan cited as saying they still like the stock, but did say the upcoming third quarter report here on November 6th caused some disappointment. Maybe we see slower than expected sales of Wegovy. Other analysts I saw as well saying, listen, news flow about potential rivals has impacted, in their opinion, perhaps the investment case for some too.
Yeah, I mean, the shares are still up about 14% year to date. Eli Lilly, by contrast, is up 52% year to date. So just gives you an idea of, again, a little bit rockier. Of course, Novo also had a big year last year for those shares.
Yep. Let's move on. BofA Securities downgrades HP Inc. to neutral from buy. The note saying print margins reversion and offset PC upside. So this one was interesting. This is analysts at BofA. They do downgrade to neutral. It's a well-known, well-respected analyst, Wamsi Mohan, who we know, Julie. And his thesis here is he just says potential upside from PCs, including even those AI-enabled PCs, should be offset. He's arguing by lower print margins. The company says has been over-earning in printing. Unlikely, he says, the company will drive upside to estimates.
Yeah, and he says any earnings per share growth that does come, he says it's going to come from share buybacks. It's not going to come from that underlying growth. He did say a couple things could change here. The company could see stronger demand for AI PCs even than he's estimating. So maybe that would more than make up for the weaker print margins. And he also is looking for any kind of maybe change in strategy from a new CFO at the company. That's Karen Parkhill. And if that happened, maybe that would also change his view.
Does maintain the price target at 37, by the way.
And then we're also looking at a call on Rocket Lab. KeyBank Capital Markets raising its price target on that company from $8 to $11. The note highlighting an increased confidence in the company's ability to scale up that business. That was after they hosted a non-deal roadshow with the company, including the CFO Adam Spice, which is a fantastic name. And so basically, they're talking about scale here. They're talking about the company potentially coming out with its own new sort of network of satellites, what's called a satellite constellation, appropriately enough. And that the analyst believes if Rocket Lab does that, it does have the capability to do so. Other companies apparently contract out that kind of activity. He's confident that Rocket Lab can do it itself.
They see 40% revenue growth year over year in 2025. They model the company to reach a near break-even EPS and free cash flow run rate as it exits 2025. This stock has been, the move has been tremendous. It's up about 80% this year, yet most on the street, they're sticking with it. Most are buyers. There's not a single sell on this thing.
It is up 80% year to date, but if you look at that chart, the huge bulk of those gains has come in the last month and a half.
Look at that move.
So it's really been quite recent, as there's been maybe some increased attention on the space industry with what's going on with SpaceX, et cetera. Maybe that's part of what has fueled that gain.
All right. Moving on, another big story. We're watching oil prices and spiking in the middle of the session on heightened tensions in the Middle East, and prices were up on the day. But overall, we know it's been down week for crude. For more, we're bringing in Andy Lipow, president of Lipow Oil Associates. Andy, it is good to see you. And kind of talk through these cross currents. On the one hand, red hot geopolitical headlines. Israel carries out a big strike in Lebanon, reportedly targeting Hezbollah's leader. On the other hand, we have this, the bearish effect here. Reports that Saudi Arabia committed to higher production. How are you trying to think through these cross currents and trends, Andy?
Well, good afternoon, and thanks for having me. As far as Israel with its conflict with Hezbollah, what we've seen actually since Hamas invaded Israel nearly a year ago is there's been no oil supply disruption due to these geopolitical tensions in the Middle East. In fact, the oil market really doesn't think that we're going to have an oil supply disruption, because for that to take place, what you really need is Iran to get into a direct conflict with Israel that impacts shipping through the Strait of Hormuz. So from that standpoint, the oil market hasn't reacted to the upside. Here recently, the Financial Times issued a story saying that Saudi Arabia had abandoned a $100 per barrel target price. While Saudi Arabia has never explicitly said that they've had a target price of $100, what we do know is they need higher prices, as does the rest of OPEC Plus, in order to support their domestic spending budgets. And it's my opinion that OPEC Plus, including Saudi Arabia, does not want to get involved in a market share price war with the rest of the world. In fact, what we've seen over the years is U.S. oil production is now at an all-time record high.
And Andy, it's Julie here. Getting back to the the sort of geopolitical side of the equation and the activity that we're seeing in Lebanon and Israel. You said the market is sort of not, that it's not going to be disruptive to supply at this point. What would change that view? Would it be Iran, for example, getting more explicitly involved? What should investors who are watching that oil price, what should they be paying attention to?
Well, Julie, I think that's exactly right. If we see Iran and Israel face off directly, then the oil market is going to be at attention, worrying about what might happen supply-wise in the Straits. I don't think it's in Iran's best interest to go to war with Israel, nor I don't think it's in Israel's best interest to go to war with Iran. But I think that the probability of the Strait actually closing is pretty small. We've seen over the decades worries about it closing, but you have Iran, Kuwait, Iraq, and Saudi Arabia all dependent on that strait being open in order to monetize their oil reserves.
And let me ask you another big thing we talked about this week on the show. Chinese authorities, series of steps and measures aimed to try and boost that struggling economy. Andy, I'm curious what you think the impact there could be on the price of oil.
Well, what we've seen out of China this year is a great disappointment on oil demand growth. In fact, as they put more electric vehicle cars on the road, as well as trucks that are using CNG rather than diesel fuel, that has certainly dampened demand this year and really added a lot to the downside pressure on oil prices. I think that the stimulus that China is trying to go through right now may help to stabilize the oil demand there. But when we look at their refinery runs over the last couple of months, they're quite low given the refining capacity that they've added over the years. And that, of course, has depressed refining margins. And you see it in the stock prices of the major refining companies here in the U.S.
So, Andy, a lot going on in short. When you put all of that together, what would be your target oil price, say, 3 months, 6 months, 12 months down the line?
I think the big picture is that the oil market remains oversupplied, knowing that OPEC Plus has a significant amount of spare capacity that they could turn on. Keep in mind, they've already deferred the return of their production cuts from several years ago. So to answer your question, I think we might see a modest increase in oil prices to the upside. WTI right now is about $68. Perhaps by the end of the year, we inch on closer to $73 to $75 per barrel, which is a significant revision downwards in my forecast, given the supply-demand dynamics that we're seeing today.
One thing we didn't even throw into all of that is Helene, of course, the hurricane and tropical storm making landfall in the U.S. late last night caused a lot of damage. Is that going to have any effect on oil and as a result, gasoline prices as well?
Well, the good news is that it did not impact any of the refining operations along the Gulf Coast. There was a modest impact on production being shut in the Gulf of Mexico as the storm passed, but that is already being restored. I would say that Hurricane Helene will have no impact on gasoline prices. The biggest issue is really getting the local facilities along the Florida coast, those terminals back up and running, and whether there was any flooding damage at the terminals inland in the Carolinas.
Andy, thanks a lot. Good to see you. Have a good weekend.
Thank you very much.
Coming up, it's the latest edition of the Yahoo Finance Investor Playbook. We're taking a look at the best ways to be positioned in small caps. Stay tuned, more market domination still to come. With the Fed's jumbo-sized rate cut, at least the first of them, now in the rearview mirror, it could be small caps' time to shine. Historically, after rate cuts, all market sectors do tend to rally, but small caps have often outperformed their larger cap peers. With just a few minutes left till the closing bell on Wall Street, we're looking at how to play small cap stocks with the Yahoo Finance Playbook. And joining us is Josh Bennett, Senior Portfolio Manager and Director of Research at Alger. Thank you so much for being here.
Thank you for having me.
So, we've been talking a lot about small caps all this year. People have been saying, here come the small caps, here come the small caps, here come the small caps. Yep. Are they coming now? Is this it?
We think the setup is pretty good for small caps now. And I know people have been saying that for a while. But if you think about it, begin with the rate cuts, which already feel like, I mean, it was a little over a week ago, but it already feels like a lifetime of news that we've seen since then. Historically, you've seen that when the rate easing cycle begins, you see small caps begin to really outperform. So it didn't matter to us whether it was 50 basis points or 25 basis points. The fact is, as the easing cycle begins, we should see that as favorable for small caps. Expanding on that a bit, if you look at small caps over the longer term, what we've seen is historically you've seen small caps trade at about a 10% premium to the large cap index. And what you're seeing now is you're seeing small caps just off 20-year lows in terms of relative valuation to large cap stocks. So valuation setup is interesting. We're likely entering a rate easing cycle. Whether it's 25 bips in the next cycle or not, we don't mind. It does feel like small caps are positioned to outperform.
Do I as an investor, do I have to believe in the soft landing scenario before I move into small caps?
I don't think you have to. Certainly the soft landing would help small caps. If we got into tough times, the portfolio that we manage at Alger, called the Alger Weatherby Specialized Growth, has a diverse holding of 50 names, and some of those names serve as ballast to the portfolio. I'm happy to talk about those later. But I don't think you have to believe in the soft landing. It does feel like that's what we're headed to. If by chance we don't get the soft landing and we enter some sort of recessionary period, we have names in the portfolio that, and this is great, what's great about small cap, they can manage their business in a way to manage through and serve.
Small isn't weak, is what you're saying.
Small is not weak. And I think it's interesting. A lot of people think that small cap companies don't have the strength, but when you look at where we operate in the small cap segment, we're looking for the highest quality small cap growth names that we can find. So oftentimes, instead of thinking about small cap names as smaller than large and therefore weak, we think of within small cap and mid cap, which is the area that we invest, we look for the best, highest quality companies. Oftentimes they're competing against local mom and pops or regional players. They're not necessarily competing against the large caps. So they're actually better capitalized, better managed with more well thought out strategies.
Well, and it's interesting you say that because I well remember Savita Subramanian over at Bank of America cautioning people on going too enthusiastically into small caps because she said a lot of them don't make money, right? Maybe a higher percentage than, say, of the S&P 500 don't turn a profit. So it seems to me if you're talking higher quality, they probably make a profit. It's probably one of your criteria?
Yes, in the vast majority of cases, the companies that we're looking are profitable. There are some cases where a company might not be profitable because they're investing heavily in technology or they're investing in their sales force. They're kind of taking steps to position for future growth. But it's not like once they turn profitable, we're going to buy them at that point. We're positioning for companies that we think, from a quality standpoint, are likely to generate earnings and free cash flow within the next 3 to 5 years, not 5-10 years out.
Let's talk about some of those names, Josh. Ollie's. Why is that a buy here?
Yeah, Ollie's is a retail closeout player. So they're the largest player in the closeout industry. This is an enormous industry, $300 billion in closeout, and over $200 billion of that is non-apparel, which is where Ollie's plays. So they don't compete with TJX. They don't compete with Marshalls. They're a large player where they do a lot of consumer CPG, so consumer products for people. And why is Ollie's a buy now? Because the consumer is looking for value more than they ever have before.
Let me ask you though, because I also think of, say, a Dollar General and Family Dollar and Dollar Tree in that space, right?
Right.
They've not been doing great.
They have not done well.
So talk to me about the differences between Ollie's and those guys.
Sure. Yeah, Ollie's is different in that they know very much what they focus on in terms of what their product mix is going to be. So for example, they don't sell a lot of the housewares, a lot of the patio furniture. They have that, but they've been focusing their attention on the products that people need right now, which is more consumer packaged goods that they know they need right now. Room air, believe it or not, was a very strong segment where people need air conditioners, they need room fans. So Ollie's knows where the consumer is going, and they know how to focus kind of on what the consumer actually needs.
What about, here's another one I'm interested to get your take on, RXO.
Sure.
Which has had a nice run. It's popped about 20% already this year.
Yeah. RXO is a truck brokerage company. So what that means is they don't own a lot of trucks, but they are the network that combines truck capacity, where there are like 600,000 trucks that are out there on the roads, with the truck demand, which would be companies that need to move stuff around. RXO owns the network. They've invested heavily, millions of dollars, hundreds of millions of dollars in their network. They're using AI technology in that network to basically match capacity with demand. So RXO should benefit as the industrial cycle begins to pick up. They'll see that benefit. I know that earlier in the day you were talking about the ports and the strikes there. If that becomes a problem, you need to move products around in other ways. That's where RXO really shines, is they understand the network, they can match capacity with demand, high quality company, excellent management team, and we think that it has years to go in terms of running.
Josh, great to have you on the show with those picks. Appreciate it.
Thank you so much. I appreciate it.
While wrapping up today's market domination, do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime. And let's see where the major averages ended the day and the week for that matter. We got the Dow up 138 points. That's about a third of 1%, coming down from the highs of the session. If you look at the 5-day here for the Dow, you have a little bit of a bump, not a huge one, but still an up week here. And also, if you look at the 1-month chart here, so we're nearing the end of the month, you got positive there as well. The S&P 500 down on the day, just about a tenth of 1%. Remember, it had another record close yesterday before coming down and is still higher on the week. And let's talk about the Nasdaq as well. Also higher in the week, almost a percent lower on the day, however. Let's look at the 1 month there as well. And we've been talking about this a little bit, that coming into September, there was a lot of talk about it. September is the weakest month of the year. Well, we just have one trading session left of September. Unless it's really, really bad, knock on the interactive, it doesn't look like that we are going to get a negative month for the major averages. So that's something notable here as we get closer to the end of the month. Now, it was tech that was the underperforming group today, so I wanted to take a little bit of a deeper dive there. NVIDIA, which had a good week until today, if you look at its 5-day chart here, up almost 5%, but wiping out some of those gains today with that 2% decline, maybe just backing off of it a little bit. Remember, we've been talking this week about the AI trade coming back, a little bit of enthusiasm coming back there with that Bain & Company report that we talked about over the past couple of days with big predictions for the AI market and Micron earnings as well. But that effect fading to some extent today. Amazon, Microsoft, and Meta also down. Apple and Google up just about a little bit. Going to also look at the leaders, which is one of Jared Blickery's favorites here. And really interesting and important, worth noting that KWEB has continued its strength here. This is the Chinese Internet ETF, up 4% today. Let's look at the week here as well. We saw a big gain for the week, up 27% on these new stimulus measures that we have seen being rolled out in China. Year to date, this group had been in the red, really, until the last few days. So this helping salvage some of the returns there, but there are still remaining a lot of questions about the sustainability and the effectiveness of some of those stimulus measures that they're taking there. Josh?
Julie, markets closed the session mixed, but the Dow notching a fresh all-time high. The major averages finishing out their third straight winning week in what was supposed to be a sluggish September, according to some. Joining us now is Martin Schulz, Federated Hermes, head of international equity strategy. Martin, it's good to see you. So maybe we'll start there, Martin, because I thought as you go into September, you're supposed to batten down the hatches, the seasonals get spooky. What happened, Martin?
Well, it's always good. Thanks, Josh. Really appreciate you having me on. I think, not every September is the same. And at the same time, I think what we're experiencing is, particularly as it relates to the Fed being much more aggressive than anticipated, and finally seeing some bazooka action, which is something we've hoped for and waited for out of China for over 2 years. The third kind of leg out there is still the U.S. election. So that still has to be determined. What's going to happen there, we don't know. But at the end of the day, I think we are seeing reflation come back to the global marketplace. You're seeing a weaker dollar, you're seeing stronger commodities, and so we are seeing a bottoming, if you will, of the global economic landscape, which we believe is currently being helped by obviously some of this monetary reflationary pressures that are brought to bear by the Fed and by the PBOC.
So is that good for everybody, Martin? I mean, if you look at, we know you look at international equities. If you look at the U.S. versus the rest of the world, with that stimulus, at least monetary stimulus coming in here in the U.S., all kinds of stimulus coming in China, how does that position U.S. returns versus international returns?
Well, I think, the Mag 7 and the large cap growth companies that have done so well, I think they have to take a breather. And we've actually, as part of our macro pyramid committee at Federated Hermes, we've been focused on small caps, as you had in your previous session. We've also talked about more value-oriented stocks and then also emerging markets. And I think from that perspective, you are going to see the cyclical parts of the economy really start to do better relative to those growth-oriented parts of the economy that have done so well so far. And we also see, as we lap really strong earnings by some of these growth companies, we are expecting, again, more emerging markets, which are more value-oriented, and then obviously small cap and value cyclical sectors are probably going to do a lot better.
Martin, let's just drill into China a bit more, because obviously it is a theme we hit a lot this week, and for good reason. Chinese authorities taking steps, trying to boost that struggling economy. You saw investors rush in, Martin. Were you one of those investors, Martin? Would you be urging clients, yes, buy Chinese equities?
Well, there's been a lot of false dawns, Josh, the last several years, and so you have to be careful. But at the same time, some of these Chinese stocks are very, very cheap. These are obviously the, if you will, the Mag 7s of China, the Tencents, and companies like that we're invested in. But at the end of the day, China still has a lot of issues to overcome. The property market is still in the doldrums. You have yet to see some of this fiscal pump priming that we believe is necessary to get the economy on better footing. Now, the first steps have been taken here recently. This is something we've been waiting for quite some time. So on the margin, we've been adding to China over the course of the last 3 to 4 months, but not in large scale. And we'll see, this could be, again, a head fake, but a longer term policy prescriptions that may come out of China will determine what we expect to see in the market going forward. And our expectation is that we see stabilization, and we do see further upside potential for some of these companies listed in China.
One of the other markets that has gotten a lot of attention has been, of course, Japan. Japan has a new incoming Prime Minister, Shigeru Ishiba, and he apparently is in favor of the Bank of Japan's plan that it's been on to start to raise interest rates more. Is Japan an area that still has some upside?
Yeah, so we use a top-down country allocation approach in some of our international groups within Federate Hermes. And what that means is we're basically picking and choosing different regions and markets to overweight and underweight. And Japan has been one of those markets where we have been overweight. And that's primarily because the yen has been obviously an accelerator to some degree. But to your point, now we are seeing a reversal in at least as it relates to the Bank of Japan's focus on raising rates. They've already kind of telegraphed that October will not see a rise, but we do expect them to continue to normalize their monetary policy in such a way that we do expect Japan to be one of the outperformers over the course of the next few years. And they've got some great companies involved and everything, obviously, from technology as well as in some of the more even local banks, which are going to be big beneficiaries of not just the TSE, the Tokyo Stock Exchange reforms, but also of obviously rising interest rates, rising inflation, something that Japan has literally not seen in over a generation. So while it's going to be a bumpy road, we do expect Japan to be one of those markets that will outperform near and long term. And our top-down country allocation approach right now continues to like Japan for those exact same reason.
Martin, so we touched on a number of different countries, regions, U.S., China, Japan. You also flagged Brazil. Walk us through some of the movements you're seeing there by those policymakers.
Well, what's interesting is Brazil, unlike the Fed, where they're trying to catch up, right? Brazil was actually at the forefront of more conventional monetary policy. They basically started to raise rates early in the cycle when they saw the first, if you will, inflationary pressures. And now, as we've seen, they're actually raising rates. It's interesting to see within the central banking community some of the changes out there. You've got Russia and Brazil that are raising. And then you've got obviously Japan also potentially in a raising mode. But then you have the rest of the world, the Fed, China, the ECB, the Bank of England, although they kept steady here recently. We do expect them to start to continue to cut. But in the case of Brazil, here's a market that we believe has a lot of potential. It's got a little bit of a political headwinds right now. Elections are over and done with, but we still think that there are some headwinds on the legislative front. We do believe that Brazil and companies like Nubank or Mercado Libre, which has a very large presence in Brazil, are very big beneficiaries of the longer-term consumption and obviously growth-oriented progress that Brazil has been making.
Martin, thank you so much. Have a great weekend.
Thanks, Julian.
Before we go to break, here's a preview of Monday's episode of the Yahoo Finance podcast Opening Bid. Executive editor Brian Stasi caught up with the PayPal CEO, Alex Chriss, as he marks 1 year on the job.
Do you see PayPal going toe-to-toe with a Coinbase and some of the, I would even say a Robinhood?
Crypto to me is a really important future element of commerce, but it's a how, right? Really what it is enabling commerce at faster speeds, high scale, globally, and at lower costs. And any time that you can move money faster at lower cost, that's better for consumers. And so we've taken the right steps in. We, again, are doing it in the right way to be regulated so that we can move money safely and securely for our consumers and make sure that their money's protected. But I think, again, we're just scratching the surface and really making it available from a payments perspective on a global scale to allow people to be able to transact anywhere in the world and do it fast, securely, and at low cost.
So you don't see, it doesn't sound like you see PayPal morphing into some form of exchange where, hey, if I want to trade Bitcoin, I use PayPal?
You know, I think we could dabble in that. I don't think that's the big long-term win for us. I think for us, the real transformation is, you know, where am I in the world where I can create the right payment to any merchant anywhere else in the world, connect the dots between consumers and merchants, and do it at much faster speeds, very securely, and at lower cost for consumers. Consumers right now are paying a ton in fees anytime they want to purchase cross-border, anytime they want to purchase from a merchant around the world. With inflation working in different ways in different geographies, it's just hard to manage money as a merchant and understand what you're paying for as a consumer. I think we have an opportunity to really play a hand in that.
So this is a rare interview for you. I mean, for the past year, you've been head down, like really working hard to reinvent this company, hiring, product, you name it. Who's Alex Chriss after hours?
Well, first, just because you mentioned it, it was one of the biggest surprises stepping into this role was how many invitations I got to conferences and interviews and all sorts of. I could have spent every waking moment.
I have an email timed. I have an email timed for my next invite for you, Alex.
It's unbelievable, but you're right. I've said no to everything. Getting execution done, getting the team around us, and really starting to innovate for customers was my number one priority coming into this year. So I've said no to about everything. It's exciting to be with you today, but after hours, you know, look, spending time with family, trying to get a good workout in, just to make sure that you know, you keep your head clean and get the stress out. But you know,
yeah,
it's been a really fun year.
Both of our muscles are bulging off the screens, and for me, you know, I think that's a good thing for both of us.
It's a filter.
It's a filter. Yeah, it's a really good thing.
You can check out that full interview on the Yahoo Finance homepage or wherever you get your podcasts on Monday, if you dare. More Market Domination Overtime is straight ahead. It was a tough day for NVIDIA, the chipmaker closing down just over 2%, but shares have soared, of course, still this year. We're about 145%. For those who are looking for alternative ways to take advantage of the stock's run, options might be a possibility. Here for the Options Playbook, sponsored by Tasty Trade, we've got Jim Struger, Kineo Capital Managing Partner. NVIDIA's trading has been interesting indeed, right? We mentioned it was down today. It was up on the week, however. And it's been like this interesting trade with AI where it runs up, and people say, well, maybe it ran up too much, and then it comes down, then it runs up again. So how are you thinking about it?
Well, the way we're thinking about it is we have investors coming to us saying, I've got too much NVIDIA. It's been a wonderful stock for a long time now, up 10 times in the last 2 years, as you said, up 140+% in the last year. What that means is investors are enormously long NVIDIA relative to everything else in their portfolio. So we've had some, I think, relatively intelligent investors raise a hand and say, I love NVIDIA, I want to stay long NVIDIA, but there's a much bigger AI theme here to be playing, and I'd love to dial back my NVIDIA exposure a little bit.
I just want to linger on this for a minute because sometimes we talk about like rebalancing your portfolio, right? Oh, because stocks have gone up so much, I'm too long stocks, I'm not long enough bonds. We don't talk about it often enough with individual stocks like this. So that's effectively what you have to do sometimes is rebalance.
Absolutely, especially in this unique case where you have investors who could be 50, 60, 70% long NVIDIA relative to an entire portfolio, right? Great stock, probably a great future, near future certainly, until competition picks up in several years. But if you're long 50, 60, 70% NVIDIA relative to the rest of your portfolio, makes an awful lot of sense to dial that back. And now people are beginning to understand that there are many other ways to participate in AI and AI infrastructure without owning just NVIDIA and having exposure to GPUs.
And so what are some of those ways, Jim? Walk us through it. What are some smart strategies?
Well, it's across the board in terms of where you are. We started an AI infrastructure fund earlier this year. It touches utilities. It touches energy infrastructure. It touches everything into the data centers. It touches water. It touches construction companies. So plenty of industrials are ways to play this. One company that we like a lot is called Core Scientific. If you're thinking about AI infrastructure, you really want to spend some time looking at the Bitcoin miners. Because something that happened earlier this year was Core Scientific, symbol CORZ, reached an agreement with a private company called CoreWeave, which is a hyperscaler. And that agreement was for CoreWeave to come in and take what will amount to about 500 megawatts of compute power from Core Scientific. And what that's done is it's taken these Bitcoin miners and extracted them from being pure play Bitcoin miners. Now it's more about high performance compute. And that's a critical element. And if you take another step back and just provide a framework around valuation, Blackstone just bought a company in Australia called AirTrunk, paid about $20 million per megawatt. So look at some of these miners. Now it's not apples to apples per se, but still from a valuation perspective, using a deal that was just done a couple weeks ago, you can overlay that on some of these miners and get a sense of the fact that their valuations are multiples away from a deal that was just done in Australia.
Okay, so how do you look at it from an options perspective then and try to take advantage of that?
Sure, so the way we're thinking about this with some of our clients is if you're overweight NVIDIA, let's start working out of that gradually, but let's exploit the fact that NVIDIA implied volatility is 45, right? Compare that to Apple, Microsoft, those are about half as much, right? So we can take premium out of NVIDIA via the listed options market and work out of some portion of that stock over time. So the way we framed it up here is looking at to November 1st expiration. If you're long NVIDIA, this was priced up this morning, so I know stock's a little bit lower, but you sell a 140 strike call in the size where you want to reduce your position, right? So what you're doing is you're matching the number of calls you're selling against your long stock with the amount of stock you actually want to reduce in NVIDIA, right? You sell that, you pocket, it was around $2.50. That annualizes at about 20% a year. Simply annualizing it, if you make the assumption that those calls expire worthless, right? Eventually, what probably happens is NVIDIA moves up, you get called away in that stock. And so you're naturally reducing your position, but you're exploiting the fact that there's elevated implied volatility in NVIDIA by doing that. So it's a nice use of the option market to take down your NVIDIA exposure while generating income.
And then the other side of that is that Core Scientific options play.
Exactly. So what we like in Core Scientific is going all the way to April next year expiration, right? Stock's about $12.50 right now. You sell a 10-7 put spread. You're selling a 10 put, you're buying a 7 put. Your maximum risk is those 3 points, and that's how you're sizing that position. You turn around, you buy a 20 strike call. Couple things here. Number one, we want this story to play out. That's why we're going all the way out to April. You also, as I mentioned, CoreWeave is expected to make an announcement in the next week about an additional 120 megawatts of compute power that they're going to contract with Core Scientific, near-term catalyst, and CoreWeave is also expected to go public next year. So Core Scientific could be a very nice proxy for CoreWeave as it goes through the process of announcing it's going IPO, and then leading up to that IPO, investors are going to want exposure. Core Scientific, CoreWeave, now in this lovely agreement together, Core Scientific should benefit from that as a proxy to CoreWeave. CoreWeave got a $19 billion valuation on an $8 billion debt raise a few months ago.
I'm going to remember this when CoreWeave is going public, and we're going to have Jim back in.
We will. Jim, thanks so much for being on set. Appreciate those ideas.
Thank you very much.
Time now for what to watch next week. October is a big month for Elon Musk and Tesla. The company expected to report earnings toward the end of the month and have its long-awaited robo-taxi reveal on the 10th. But to kick things off, Tesla is expected to report delivery numbers for the third quarter. It's coming on Wednesday. Analysts estimating deliveries to come in at about 462,000, but some analysts are saying that number could be as high as 470,000.
Turning over to the labor market, we'll be getting a new batch of jobs data starting next week, starting with monthly JOLTS numbers. Remember, that's the Job Openings and Labor Turnover Survey. That comes out Tuesday morning. Economists forecast openings will increase to 7.7 million in August. And then, of course, on Friday, we've got the full jobs report for September. That's out ahead of the open. 130,000 non-farm payroll jobs expected to be added. And the unemployment rate forecast to hold steady at 4.2%. Of course, jobs data now at the forefront for the Federal Reserve after it cut rates for the first time in 4 years.
And on the earnings calendar, we're going to hear from Nike, ConAgra, and Carnival Corporation, among others. Nike reporting first quarter earnings on Tuesday after the close. Analysts expecting weaker sales for Q1, but we'll listen closely for any commentary on the company's recent CEO transition.
Plus, on Tuesday, we could see the start of that port strike we've been talking about along the Gulf and East Coasts. If the longshoremen go on strike, it will be the first time that all of these ports will be shuttered in nearly 50 years. That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Wall Street riding 3 straight weeks of gains. The Dow closing at a new record high as inflation data shows ongoing easing. We're diving into the key themes of the trading day that's straight ahead. Plus, White House officials trying to prevent a dock workers strike. The ports along the East and Gulf Coast could shut down starting Tuesday, and there could be major implications for the economy and your holiday shopping. We're going to explain that straight ahead, too. And how about artificial intelligence helping with hiring? We've got the CEO of the company doing just that, and he's got some very big-name backers. Well, tens of thousands of dock workers are likely to strike next week along the cargo ports on the East Coast and Gulf Coast. While this stoppage could, of course, have big implications for the U.S. economy, it may also add to uncertainty to the 2024 presidential election. Here to weigh in on what is at stake for the U.S. election is our very own Washington correspondent, Ben Werschel. Ben, it is great to see you. So in your latest piece, Ben, you go over how this, the potential port strike could, of course, have these very big economic ripple effects. It could also have political ripple effects. Walk us through that, Ben.
Yeah, for sure. We're seeing it this afternoon. You mentioned the meeting of the White House. I just got to note that the meeting is wrapped up, but no word yet on how it went. But this is a bunch of Biden officials: Pete Buttigieg, Acting Labor Secretary Julie Su, Lael Brainerd, with the management side here. So they're not mediating yet, but they're sending a message to the management, which they've also sent to the unions, that you guys basically it's a pressure message. You need to get this done. You need to get this done quickly as soon as possible. So, and that speaks to this larger theme we're talking about here about the political ramifications here. This is an event that we'll see what the economic consequences are, but it's clearly going to kind of ripple through the campaign. There's only 38 days left in the campaign. In addition to the kind of nationwide economic unrest, it could unsettle a few sort of facts for people to keep in mind. One is this strike, if it happens, has a lot of exposure in swing states. Savannah, Georgia is one of the biggest ports in the country. Georgia is one of the closest states between Kamala Harris and Donald Trump right now. Same with North Carolina. Wilmington's a big port, and there's a bunch of facets there that could impact everyone. And one thing you hear from from supply chain officials is that the auto industry is one to watch here if this becomes a prolonged strike. That matters a lot in Michigan, obviously. And then this goes into a lot of kind of complicated union politics this year right now. Donald Trump is making a real run for union votes, so I can make the case how he's going to respond to this could be polar opposite. It sort of all depends on how things go. So it's definitely set to ripple in sort of unpredictable ways. So it'll be an interesting one to watch next week, depending on how things go.
You mentioned Trump there, Ben. Has he commented on this at all?
Not yet. I mean, it's interesting how sort of staying back they are. He was actually in Savannah this week by chance, and he talked about the port there. He was doing a manufacturing pitch, and he talked about how he was going to make the port bigger and better. But he didn't talk about the labor. I think there's a sense of sort of waiting to see how this goes, because there's a scenario next week where Biden jumps in and does an injunction. It's a law called Taft-Hartley, which essentially sends the workers back for 80 days. That kind of changes what the politics are here. Otherwise, if it's a protracted strike, it's a sort of different approach. So there's not a lot of chatter yet, but I think we'll see that change quickly.
Ben, always great having you on the show. Thank you, my friend.
Yeah. Good to talk to you.
Believe it or not, Black Friday, the traditional start of holiday shopping, is just 63 days away now, and with inflation cooling, consumers are expected to spend big. However, the looming port strike could put a damper on the holidays. And joining us now is Naveen Jaggi, JLL America's president of retail. Naveen, it is great to see you. Let's start there, Naveen. You know, obviously we've been talking a lot this week about this potential port strike. How could that affect the retail sector, the retail industry, Naveen, which you know very well?
Yeah, it's a great question, and I think it's a two-pronged answer. One is the holiday sales as well as the broader inventory management that retailers have. So fortunately, this past week, I spent time with quite a few retailers, asked that very question: how do they react to the potential port strike next week? And their answers were quite illuminating. One was that in terms of holiday product, they have their product in the States. They have it in distribution centers or at the stores. So in terms of how they manage the inventory, really depends on the better second half of the holiday season. And secondly, and most importantly, most of the items that are being sold, the toys, the electronics, and the soft goods clothing that are pretty predominant when it comes to holiday sales, those come from Asia. And of course, we know this port strike is likely taking place along the East Coast of the US, not the West Coast. So the real big challenge would be whether or not at the back end of the holiday season, when replenishment comes for the majority of products you may want to buy, that there could be a shortage of products going to the second half of December. So right now, October and November don't look like an issue when it comes to the holiday strike. It really depends on when you get back to December and the second half of that month, where you may see shelves impacted if in fact the strike does take place.
Are these companies, Naveen, are they in a position to better navigate, you know, a potential shock like a port strike? Because we did have economists come on the show this week, and some of them made that case.
Absolutely. We went through this back in 2020. So we now know that when it comes to any kind of impact to supply chain, we've gotten smarter and better. Look, we took a big shot in March, April, May, and June of 2020. Retailers got smart about how much inventory they need to keep on hand in their distribution centers as a way to avoid any potential impacts, whether it's a pandemic in 2020 or a strike in 2024. They've gotten smarter, they've gotten better, and inventory management is key, and not being dependent on one particular place where your product comes from. So a few retailers, Josh, have told me that, you know, from their standpoint, diversifying their supply chain, whether it's coming from the South and Mexico, East Coast, or the Asian countries, they made a point to not be so burdened by one particular sector, which will help offset the risk of a disturbance.
So there is this risk, Naveen, of a port shock. But I'm curious, we mentioned the intro there, you know, Black Friday is going to be here before we know it. What are your estimates? What are you looking for, Naveen? How strong a holiday season is this going to be?
Well, we've done lots of holiday surveys. We interviewed over 1,100 people across our portfolio over the last 30 to 45 days. And interestingly enough, people are quite bullish on spending this year. Now, the big twist that we're seeing is that they will spend more money on experiences and eating out and dining out than they will be on buying merchandise and product. That started a trend back in 22 and even 21 to some degree, but we're seeing it now shine more than ever. People want to spend money on entertainment, and whether it's concerts, like we know Taylor Swift was a big hot ticket earlier last year, and we're hearing the same thing again. They want to spend money on entertainment and experiences. So to me, I think we're really bullish on the consumer spend. And like you've alluded to, the market is up. When the market's up and unemployment is low, and now we have softening of interest rates and softening of inflation, people feel pretty darn good about the overall state of the economy, which makes them spend more money than they may think about.
Did you, I mean, you know, we often talk about the consumers. If there's one consumer, of course, there's all kinds. I mean, in your survey work, Naveen, did you detect any notable differences among consumers, just in terms of age, demographic, socioeconomic?
Yeah, so the boomers still continue to spend, but now the millennials are picking up the slack where the boomers may stop spending as much. You know, we tend to talk about the boomers being the big driver in the economy, but it's the millennials now that are the future drivers of the economy. We're also seeing that the lower income strata, that household income of below 50 and 60,000, they're going to spend more money on discounting. Every year, we hear more and more about that discounting sector spending more, getting more of the market share from the baby boomers and the people making $50,000 household income and less. So that to me probably isn't a big surprise, but we heard more from our survey about then one sector this time than we had last year.
Naveen, always great to catch up with you. Thank you so much for joining us. Appreciate it.
Thanks, Josh.
Inflation is easing, small caps are rallying, and all eyes are moving to the labor market. Here with the trading day takeaways is Yahoo Finance's very own Josh Schaefer. Josh.
Josh, we've been talking about it all week. We've been waiting for a big macro data release. We finally got one with this morning's Personal Consumption Expenditures Index, PCE. And of course, the core version of that, which takes out food and gas, is the preferred inflation measure of the Federal Reserve. So I want to just take a look at what we got here. Core PCE year over year, increasing 2.7% in August. You can see a slight little uptick there, but largely not something economists hadn't been expecting. And this is where, as we've talked in the past, I like to go we're talking about levels here when we talk about 2.7, right? But let's take a look at trend. The trend is good. So we're looking here, this is your level again, right? That little blue line. But look at purple, this is 6-month annualized. So inflation over the last 6 months, that's headed lower. We have the Fed's 2% target in here at light orange. You look here, the 3-month annualized, so over the last 3 months, we've been pacing at 2%. So this inflation print largely telling the story that the Fed told us last week. They feel like inflation is falling to target. It's not going to happen tomorrow. It's not going to suddenly go to 2%, but things are on track, and that allows the Fed to start cutting rates in sort of a good print when you're thinking about moving forward, I think, for what they can do with policy.
So a PCE print hits and everybody immediately starts, the discussion starts, okay, what does Jay Powell think of this print? What does it mean for the Fed?
Yeah, you saw Fed futures move a little bit this morning, right? So it's about a 50-50 right now for 25 to 50 basis points, whether they're going to do another big cut. You didn't see it move that much, and I think it's because it's not even October yet. The next meeting's in November. There's a lot of time between now and then.
A lot of data.
You're going to get another one of these. You're going to get another inflation print. You have 2 labor reports. You have another CPI print. There's a lot more to come through before that meeting, so I think we all got very obsessed with looking at those Fed fund futures over the last couple of weeks before the meeting, but maybe put those on the back burner for a little bit because that meeting's kind of far away.
All right, Schaefer, number 2.
Takeaway number 2, small caps rally. You know I always like to look for something that moved up on the day, Josh, and there really wasn't a ton of exciting action today, but we did see a little bit of a bid in small caps. So I'm going to go over to the intraday today. You'll see it was up marginally. It did better than the S&P 500. What's been interesting to me here, if we go to a 10-day, haven't seen a massive rally in small caps since the Fed started cutting. Remember, that's been a big part of the base case. And I want to point out to you why I think that is. So if we take a look at this chart from Bank of America, what we're looking at here, a lot on our screen, right? This is the months after a Federal Reserve rate cut here in purple. Small caps usually outperform large caps. That's where we're in the positive territory, right? But these light blue circles are important. How often does that happen? It happens less than 50% of the time. Why is that? Because it depends on what the economy is doing. And I don't think we know that answer yet, right? The Fed cut by 50 basis points, but is that because the economy is slowing too much? I don't think the market is that confident in that answer yet, and investors are sort of waiting. Should they pile in, should they not pile in until they get that answer?
We had a small caps guru on the show today, fund manager, and I asked him, do you sort of have to believe in the kind of soft landing thesis? Do I have to believe in that story as an investor before I move money into small caps? He said no. He said that's a misconception. As he put it, small does not necessarily mean weak. He said in his portfolio, for example, he's got small caps that are more resilient.
It's interesting because the head of trading over at Citi, Stuart Kaiser, said kind of the opposite this morning, but I think he's talking about the index as a whole too, right? Maybe the Russell. He said if you get that soft landing and these rate cuts are coming while the economy is strong, very bullish for small caps. He said he's not a buyer if the economy is not doing well. So it'll definitely be interesting to see how that trade plays out. We're talking soft landing.
Yep.
We're going to get a couple more answers next week, Josh. So we have that September jobs report coming out next Friday. That's going to be your headline next week for market action. Here's what we're looking for. Non-farm payrolls, 130, slightly lower. Unemployment rate flat. I think that's a big one. Average hourly earnings coming down. But I think the unemployment rate's going to be key, right? Because remember what we've been looking at here. Steady climb up, right? Do we see the unemployment rate tick higher next week? I think if we see that, it seems like strategists feel like market's going to be a little skittish based on that.
And economists will now argue, listen, it is the labor market that is more pivotal, more important to determine the size of that next cut than the inflation.
It's back to our beginning discussion, right? With inflation falling, this is the trend to watch, right? Again, we're talking about trend, not levels. This is moving up. Does that trend continue? If it does, it seems like strategists largely think that will weigh on this stock market rally.
We'll be watching. Thank you, Joshua. Coming up, the future of job recruiting. I'm going to be speaking to the CEO of AI hiring platform Mercor on all the latest hiring trends and discuss what's next for both job seekers and employers. That's coming up next. Mercor adding itself to a growing list of AI startups attracting major investments. The company recently raising $30 million from Twitter co-founder Jack Dorsey and venture capitalist Peter Thiel, among other top Silicon Valley names, putting the company's valuation at $250 million. So what's next for the burgeoning AI company? Joining us now is Mercor CEO Brendan Foody. Brendan, it's good to see you. So maybe for those who might not be familiar, Brendan, just quickly explain your startup for us. What's the problem, Brendan, you're trying to solve for?
Of course. Thanks so much for having me on. The premise is that similar to how there's this legacy services industry around people manually reviewing resumes, manually conducting interviews, and manually matching people with jobs, Mercor is able to automate all of those processes with LLMs, not only far more scalably, but also far more effectively, where we've processed over 300,000 candidates, conducted hundreds of thousands of verbal interviews, asking nuanced questions about people's background, and matched thousands of people with jobs.
And so, Brendan, give me maybe we'll do a hard example. Let's say, I'm a CEO, I'm a company, I'm looking to hire a new accountant. What happens next?
Yeah, so the process would usually be that you can go onto our company portal, type in that you want to hire an accountant, and then it'll do a rank search over all of the accountants that we've interviewed, where you can even go onto our platform right now and try it if you want, and it'll show you accountants that we've determined have competency in that specific area, or we can filter by how soon they're able to start, and automate the entire process associated with onboarding that person in a compliant way and handling all of the payment.
And Brendan, would there be certain kind of jobs you think this technology is better suited for than others? I don't know, maybe I'm a CEO, I'm looking for a great people person, right? Is the technology suited for that or no? There's certain industries, certain verticals to be better suited for.
What we've been mainly focused on right now is staffing use cases where people are hiring for from anywhere from a few weeks to a few months and are okay with this lower touch approach. It's very effective across all of those, ranging everywhere from software engineers to lawyers all the way to accountants. But I think very soon we're going to see the technology also applied in a more significant way to traditional full-time hiring, where people are using it for every role because it just quantitatively performs better than humans at assessing talent.
And Brendan, what's the underlying technology you're relying on there? Which LLMs, which large language models?
Yeah, so we use various LLMs, but it's predominantly OpenAI's GPT series as well as Meta's Llama. And we post-train those LLMs based on all of the proprietary data we have on candidates to best understand who's going to perform well at a given job for what reasons.
If I'm watching this, Brendan, and maybe I work in HR, maybe I'm just starting out in a career in HR, should I be worried about this technology, Brendan?
It's a good question. I think that there's certain jobs that people do or elements of the job that might not exist. And so it's important that people are thoughtful about how that role is going to change over time, where they might focus on the more people-oriented parts of this, or the parts that will be more durable. But I do think that there is going to be a degree of displacement in what those roles look like in the future.
There's there's a kind of expression I've heard out there, Brendan, now, which is, AI isn't going to take your job, but somebody who knows how to use AI effectively might take your job down the line. You think there's some grain of truth to that?
I do. I think that we're going to have many more processes in the economy automated. And as a result of that, we're just going to produce a lot more. We're going to have, way better HR systems that are able to talk to every candidate, that are able to give these incredible experiences to each person. And that's going to be this collaborative process between humans and machines, and how that fits together is what everyone's trying to figure out right now.
And Brendan, how did you come up with this idea?
We were very, very excited about labor internationally and how there were all of these brilliant people around the world, predominantly in India where we started, that weren't being given opportunities. And the reason was that there was a talent density issue where the average person in India might have been lower caliber than the average software engineer in Silicon Valley. And so people weren't considering candidates. But when we were able to build technology that could screen every resume, conduct an interview of every candidate, and figure out who is able to perform well, we were able to find all of these incredible people that were otherwise ignored and not given opportunities and create thousands of jobs for them. And I think it was very, very fulfilling early on to see that on a small scale, but the idea of building software that can scale to create those experiences for millions of people is what's most exciting to us.
Brendan, when I look at the investors in your startup, it is a really impressive list. You know, Jack Dorsey, Peter Thiel, from what I understand, Larry Summers, Bill Gurley and his team at Benchmark. I mean, this is a who's who group of investors here. How did you convince them, Brendan, to invest in this startup? What was the pitch? How did you get them enthusiastic enough to commit capital here?
It's a good question. With Benchmark, it started out the other way around where we weren't fundraising at all. The business was growing extraordinarily well. We've been sustaining 50% month over month growth, 5-0. And so they chased after us, got us excited about working with Victor and Bill and the entire Benchmark team. And then from there got introductions to the other angels who liked what they were building, and we're very fortunate to have worked with all of them.
Brendan, it was great to have you on the show today. Thank you so much for joining us.
Absolutely. Thanks so much for having me.
And coming up, we're looking at our why lower rates don't always guarantee a soft landing in today's chart of the day. Stick around. We're asking for a trend on the other side.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
For our chart of the day, we're looking at why a soft landing for the economy might not happen. Yahoo Finance's Julie Hyman joins me now with a closer look.
Well, or at least why the Fed cutting rates does not guarantee that a soft landing could happen. And this is based on the piece that Nick Timmeros of the Wall Street Journal wrote and published today. He, of course, one of the most closely watched journalists who covers the Federal Reserve. And the argument he's making has to do with what some people call the sort of transmission mechanism. In other words, the economy where it is right now, the Fed begins cutting rates. How does that then transfer? How does it play out in the economy? And the argument is that there's an unusual situation right now. We had low rates for a long time. Then the Fed, of course, rapidly increased rates by a lot. Now they've begun cutting. But what that's created is this situation where many people still hold debt. People, corporations, what have you, hold debt that is at very low interest rates. So they don't have an incentive, perhaps, to take out new debt, to refinance, etc. How's that playing out when it comes to mortgages, for example? Well, here's where the 30-year rate is now. As we know, it has started to come down, and this week got closer to 6%. It's lowest that it has been in a couple of years, which is good news. But here's the wrinkle with that. Here is where people who currently hold mortgages, the average of where their mortgage is. Guess what? It's about 3.9%. So if mortgage rates right now are at around 6%, and the average of all outstanding 30-year mortgages is 3.9%, well, those people still don't necessarily have an incentive to sell their homes, to refinance their homes, etc. And that is why you don't necessarily get that loosening up and that soft landing that the Federal Reserve might want. Now, likewise, when you're looking at corporate debt, you get a similar situation. Companies take out debt, sell corporate bonds, for example, when they want to invest in the business. They want to hire, they want to build physical facilities, they want to invest in research and development or acquisitions. Well, the debt that they have taken out when we saw very low interest rates for a long time is still at those low rates. So again, to sort of increase economic activity, to take out new loans from banks, you're going to have to see something spurring that activity. And the argument is perhaps that because folks took out their debt here when it was still much lower, that there's not yet that impetus for them to do so. So this is something definitely to continue to watch, Josh.
We sure will. Julie, thank you. And that is wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.